my name is Nur Afida binti Sheikh Hussein and my metric number is 295319 and I'm choosing Pensonic Holding Berhad as my individual assignment. So for the background of the company, Pensonic Holding Berhad is a Malaysian company that sells electrical appliances. It was founded by Chu Weng Kak in 1965 as a shop in Penang, selling electrical appliance trading under the name of Kit Radio Co, with Chu as a sole proprietor. In 1982, Chu started the Pensonic brand name to produce locally manufactured electrical appliances. Next, this slide shows balance sheet of Pensonic Holding Company where we can get it from Bursa Malaysia. Balance sheet shows company asset, liabilities and shareholder equity. Next is income statement that shows a company revenues, expenses and profitability over a period of time. Here is operating activities from company cash flows. And here is financing activities and investing activities. Here is the aggregate 3-year cash flow from operating, investing and financing activities of Pensonic Holding Berhad. So let's take a look one by one. For operating activities, in 2020, the company generated 35 million from its core business operation, indicating strong performance and efficient management of working capital. However, in 2021, the operating cash flow dropped to 90 million, possibly due to lower sales or higher operating expenses. By 2023, the operating cash flow rebounded to 35 million, reflecting a recovery potentially from increased sales. Next is investing activities. The company shows significant investment in long-term assets in 2020 with cash outflow of 5 million. This investment reduced in 2021 to 3 million, suggesting completion of major project or strategic reduction in new investment. By 2023, the cash outflow further decreased to 1 million, indicating even fewer investment, possibly as the company consolidated its asset or reduced capital expenditures. From the 3-aspect cash flow, the financing cash flow shows significant change over the 3-year period. In 2020, the company experienced substantial outflow of 29 million, likely due to repaying debt or dividend payment. This outflow decreased in 2021 to 50 million, indicating reduced financing activities. In 2023, the outflow increased again 32 million, suggesting significant debt repayment or capital return to shareholders. Next is discussed two possible underlying reasons for the significant change, either due to significant change in certain accounting item or a shift in accounting principle or other reason. First is debt repayment and issuance. The company might have significantly increased its debt repayment or decreased new debt issuance over the years. This could be due to the strategic decision to reduce leverage and strengthen the balance sheet, potentially influenced by rising interest rate, making debt more expensive to service. Next is dividend and share repurchase. The increase in outflow could also be attributed to higher dividend payment or more aggressive share repurchase programs. This might be a strategy to return excess cash to shareholders, reflecting confidence in the company's future cash flows, or a reaction to shareholder demands for higher return amidst a stable or growing market. So here is the calculation for Pensonic's profitability ratios, which is RNOA, OPM, ROCE from 2020 to 2023. Now I will discussing about the trend of profitability performance of the company. For RNOA, increased sharply from 20.51% in 2020 to 33.145% in 2021, indicating a substantial improvement in how effectively the company was using its operating asset to generate profit. However, by 2023, RNOA dropped to 11.81%, reflecting a significant decline in operating efficiency. The OPM followed a similar trend, rising from 30.68% in 2020 to 18.25% in 2021, suggesting better cost management and higher operational efficiency. Yet in 2023, the OPM decreased to 8.07%, highlighting issues with maintaining profitability from core operations. The ROCE saw the most dramatic change, climbing from modest 3.79% in 2020 to an impressive 22.88% in 2021, showing significant returns on shareholder equities. However, it plummeted to negative 5.91% in 2023, indicating not only a loss of profitability but also potentially significant financial distress impacting equity return. Lastly, from the profitability analysis, identify two major issues of the company in achieving higher profitability performance. First is operational efficiency volatility. The considerable reduction in RNOA and OPM between 2021 and 2023 indicate a persistent issue with operational efficiency within the organization. This might be the result of rising operation expenses, poor cost management, or interruption in revenue creation. Secondly is stability of finance and return on equity. The sharp decline in ROCE to a negative figure in 2023 denotes